This is Melanie Queen from Queen's Wellness Accounting, and I'm going to go over the balance sheet. So what the balance sheet is it tells you what your balances were in each of your accounts as of whatever date you choose. So this one happens to be as of June 30th, 2017. You can pull this report as of the current day, as of today, in QuickBooks if you want. But this is as of June 30th, 2017. So, and this is showing, okay, so in their checking account, that's the balance, and this is the balance in the savings. The total balance between the two bank accounts is this. Okay, so your total accounts receivable, and accounts receivable is the money that your clients owe to you. So that is invoices that have been sent out that haven't been received back to you yet. And then you have your inventory, and you have some undeposited funds. So undeposited funds are funds like cash that you've entered in that you haven't deposited into your account, or they could be funds that were not deposited into a bank account for the business, but rather you deposited into your personal checking account, which what you really should do is deposit it to your business account, and they would do a transfer. Just so that for the accounting purposes, it's just a lot cleaner that way. So those undeposited funds should really be zero. We should really try to keep up with that, but sometimes it happens. Sometimes you get paid cash and you don't get to the bank right away. That happens. So then this is your total. This is other current assets besides your bank accounts and your accounts receivables, and money that hasn't been entered into the bank or inventory. Then you have your total current assets, and your total current assets is the total between all of those. So see it how it sums up your bank and your accounts receivable and your other assets. Then it looks like we have a truck. So the truck is valued at that much. And then other the total fixed assets. So fixed assets are like cars and trucks that are in the business name. So he just has a truck here. And then, so this is the total assets. So that's your total current assets plus your fixed assets. And that becomes your total assets. Then we go down to liabilities. And liabilities is what you owe to someone else. So currently, accounts payable, so you owe vendors this amount. And then you have, it looks like a business MasterCard that you owe that much. And you have, it looks like a few loans that you owe some money on. So these are some other current liabilities. So this is your total current liabilities. So that is between the total accounts payable, your total credit cards, your other current liabilities. This becomes your total current liability. So everything that you currently have due. Then you have your long-term liabilities, which is anything that is long-term, like long-term notes payable. He's got a notes payable here. A lot of times long-term means over a year. So then you add up your long-term liabilities and your current liabilities, and you get your total liabilities. Then you have your equity, which is your beginning balance. Equity is what you put into the business when you started. He's got a negative because it looks like he's probably paid himself, so he no longer has beginning equity or opening balance equity. And he has some net income that he's made. So his total equity is negative because he has his income that he's made, but he's paid himself, so he's got negative equity, which is fine. So then your total liabilities and equity is this amount. Now, I highlighted added the total liabilities and equity and the total assets because these two numbers always balance on a balance sheet. So you have your liabilities and you have your assets, and both sides always balance on a balance sheet. If you have any questions about this, please contact me at melanie@queensba.com, and have a wonderful day. Thank you.